Tiffany, it feels like since 2008, our policy has been basically, in case of emergency, break glass and bring in the Fed. Is there anything the Fed can really do to make this more constructive? And in fact, if they really do a lot, could it make the markets even more spooked?
So I think ultimately, I think the Fed, the Fed needs to respond to weakness in the U.S. economy. I think the weakness that we've seen so far, and as I mentioned, the Fed looks at labor markets pretty closely. It's starting to spill over more clearly in labor markets. So the Fed, in order to keep this expansion going, they do need to provide additional accommodation. So we think they cut interest rates again in September, and probably cut, more in the back half of the year. So we think it's totally appropriate. However, whether they're able to sort of arrest the downturn, I think is there's some question around that. But ultimately, we think that they will be able to. But I think additional accommodation here is completely appropriate. The things that you kind of weigh the benefits and costs of these things. And when you look at the cost of potentially higher inflation, well, inflation has been relatively subdued, although it's ticking up a little bit lately because of higher tariffs. I think the cost of higher inflation is relatively low, and then the other cost would be a buildup of financial sector imbalances. With all of the uncertainty that we're seeing, it's just really hard for me to believe that you're going to get some irrational exuberance, that causes a bubble.